Hello traders, today we'll be going over market structure. Mastering market structure is extremely important if you want to become a profitable trader. It allows you to identify and make strong predictions upon the direction of the market. Utilizing market structure will put you on the winning side of the majority of trades. Now, what is market structure exactly? Well, there are a ton of different markets that exist. Every market contains data that is compiled which reflects what is being sold, bought, and/or traded. Stocks, forex, and crypto markets all show what price looks like over time. So you can use charts of market data to start to form opinions about what will occur in the future. In a financial market, there are certain variables that influence price movement. This can be the volume for the day, the rules and governance of a particular market, or simply just the spread of the bid vs the ask, along with many other influential factors. The market reacts to all these different influences to tell an overall story about the market. This story has repeated and recognizable patterns that follow the same behavior. These make for great trading opportunities. So with that being said, you want to be aware of three types of market structures. Those are trending, range-bound, and volatile markets. Trending markets occur when there is a clear directional movement in price. This means that price is either moving up or down in a sustained and continuous manner. These are my favorite markets to trade because there is less random movement, meaning less risk. Secondly, we have range-bound markets which occur when price is consolidating between levels, so you'll start to see that price is either rejecting or bouncing off the same key levels. You can use horizontal support and resistance lines to further identify this type of market structure. Lastly, you have volatile markets. With these, you will see big and sudden movements in price. They often occur after the release of unexpected news, earnings release, or because Elon Musk tweeted. People sometimes use candlestick patterns to spot these movements, but breakthroughs through supports and resistant levels are favored to identify this structure. Okay, but how do we identify these markets just by looking at the chart without any indicators? Well, a lot of people like to use structure points, aka swing points. On this diagram, they are the orange circles. These orange circles are where price is making highs and lows, and when you start to see these highs and lows, they'll start to form structure and certain patterns that will give a clear idea of the behavior that you can expect to follow. Everything above the line are swing highs. Everything below are the swing lows. In a trending market, you'll have bullish and bearish. Bullish means that buyers are in control and the market is trending up, while bearish signifies that sellers are in control, and the market is trending down. In a bullish market, you'll have low, high, higher lows, higher highs, higher lows, and higher highs. It is the opposite in a bearish market. In a bearish market you have high, low, lower highs, lower lows, lower highs, lower lows. You can look for these swings points to get a quick idea of the market direction. Another way to identify market structure easily is using breaks of structure, or BOS. This is similar to structure points, but looking at the overall move. So say you're seeing new higher highs being formed, indicating you might be in a bullish trending market. Then a low is puts in a new high, running through previous market structure. This now becomes another reasoning to suggest bullish market bias. The same goes for a bearish example where lower lows are occurring, and suddenly previous market structure is taken, providing a new lower low, ultimately indicating bearish market. Now another key identifier, which is just the opposite of a break of structure, is a change of character, or CHOCH. These are very important because these can indicate reversals or when the trends are starting to change or look the opposite direction. Many supply and demand traders also use them for entry opportunities. Let's look at the diagram to understand. Say we are making continuous higher highs and higher lows. Then eventually we come down, breaking through previous low. Now keep in mind, when you're in a bullish market you want to see new highs being made. But here we break through this low and also fail to make a new high, which may indicate that we're in a bear market. We also break through this low as well. Furthermore, since this low didn't give us a new high, we can confirm that we have now shifted to bearish market structure. The same thing goes for a bearish market where you want to see new lows being made. And then we come up to make a new higher high. We also break through this high right here, eventually running through all the previous highs. This indicates a valid shift in market structure and a change of character. The last concept you want to understand is continuation phase versus pullback phase. This concept is strictly relevant to trending markets. In a trending market, you want to see either price make new highs or lows, ultimately favoring one direction of the market. However, price never just goes straight up or straight down. That means that there will always be both directions playing out, but one side will dominate. So looking here at this diagram, you see that the light blue arrows indicate the continuation phase because they are the leg of price that goes in the direction of the overall trend. The gray arrows are the pullback phases because they are going opposite of the overall trend. You can capture bigger trades by trading with the trend and entering during the continuation phase. In a bullish market, these will be from lows to highs, while in bearish market these will be from highs to lows. Hope you enjoyed this helpful video on market structure. Watch multiple times to really grasp the concepts explained. Be sure to like, comment and subscribe for more informational videos on becoming a better trader.